Good morning and welcome to this Monday, November 1st, 2021 edition, Trading Places live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. We're starting off a new week. We're starting off a new month. November tends to be very, very kind to the bulls, and at least it looks like we're going to get off to a decent start. At the beginning of the day, we've got Dow futures up 130, S&P 500 futures up 12, NASDAQ futures up a little over 20. So it does look like we'll get off to a decent start. Of course, before we get into all of that, let me take you over to Earnings Beats. For those of you who are new, first of all, welcome. Appreciate you stopping by. And of course, those of you who have been with us for a long time, we appreciate your support. At our website, if you are new to Earnings Beats, what I would do is encourage you just to scroll down. So you go to earningsbeats.com and then scroll down. We have a free newsletter that I publish 3 times a week, Mondays, Wednesdays, and Fridays. It's completely free, no credit card required. You can unsubscribe at any time. All you need to do is type in your name, email address, hit that subscribe button, and we'll make sure we start getting things out to you. We do have some events coming up later in November. Some of these events are free, and the free events are open up to our entire community, including the Earnings Beats Digest subscribers. That's one of the reasons why it's really important to get on this list, because we do send out our room instructions to all of our for all of our free events to the entire Earnings Beats Digest community, as well as our paid membership at Earnings Beats. So make sure you sign up there. I mean, the newsletter is very brief. It's just a couple paragraphs and a chart. But it'll tell you a lot about how we look at the market and the things that are important to us, including relative strength and earnings and gaps and candlesticks and those sorts of things. But I think it'll just add to your overall trading arsenal, if you will. Let's move on and take a look at what happened on Friday, how we closed out the week. The Dow Jones Industrial Average up 89 points, closing at a new all-time high. S&P 500 closed above 4,600 for the first time in history. It was up about 0.2% or 9 points. The NASDAQ closed up above, actually almost right on 15,500, which was an all-time high. Mid caps not at an all-time high, but did finish up just fractionally on Friday. Small caps, this was the one group that was down. But it was just a small fraction, just a couple of points. Overall, pretty good close to the week. Leading to the upside, we had healthcare rising almost 1%, technology 0.4%, communication services 0.3%. But you can see the difference in the charts. Healthcare now has moved back up above both of its moving averages, though it hasn't broken out. Then you've got technology, which closed at an all-time high on Friday, clearly above its moving averages and breaking out there. And then you got communication services, which up until the beginning part of September was one of the better areas in the market, but it's been struggling of late, but it did come back a little bit on Friday. Still needs some work to get back through these moving averages. We want to see that 20-day moving average turning up and getting through that 50-day moving average. And so we still got a lot of work to do here on communication services. I would say probably the worst of the relative weakness is probably behind the stock at this point. So I wouldn't be surprised to see communication services begin to turn back up again. But right now, I think one of your clear leaders is technology and consumer discretionary, which is not even shown here. But that's been a very strong group of late. Real estate was the worst performer on Friday, but we've been strong in real estate last couple of weeks. I just have a bigger problem, maybe long-term on a relative basis, because real estate is among our defensive sectors. And during secular bull market advances, I really want to be overweighted in the aggressive areas, because historically, that's what carries the market during these advances. So I'm okay with real estate. Real estate's fine, but it's just, I don't know that you're going to find leadership here as we go forward. From an industry standpoint, just wanted to point out autos just on fire. Another big day on Friday, gaining another 3%. I mean, this chart looks pretty much like Tesla's chart. Tesla's been carrying this index, but other stocks within the group also are starting to perform pretty well also. So we'll go through and look at some of those charts in just a bit. All right, moving on to the 10-year Treasury yield. Let me give you an update here, get the latest. Right now, we're at 1.59%, which is up 3 basis points. So maybe look for a little strength out of the gate with some of those financial stocks, maybe the industrials. Industrials have in the past absolutely loved the month of November. And so that's a group that, if you look down, had started to strengthen in October, pulled back, still above that prior low in September. I'm going to say it doesn't go back below that September low. I think we're going to start to turn higher on the industrials. I think the big thing here was our yields pulled back. I don't know that they're going to pull back a whole lot more. That has hurt the industrials. It's hurt the financials. But with the yield rising at the open today, I expect both of these groups maybe to have a good start to this week. We'll see whether or not they can carry it forward, but a lot of that will probably depend on the yield. Which way does it go? We have a big jobs report at the end of this week. If the jobs are strong, you could see the yield right back up near that 170 level, maybe even 175 to challenge that March high. And that would be very good for both the financial and industrial areas. All right. Let's see. What else do we have for today? Let's get into, well, let's take a look at the major indices first, because I want you to see there's one group that's not performing particularly well, one major index, and then there's another one that just recently broke out that's starting to look really bullish to me. But let's go through all of them. So first, we got the Dow Jones Industrial Average clearly breaking out. Transports, let me just point this out, because the Dow theory looks at the Dow Jones Industrial Average and the Dow Jones Transportation Average. And when they both break out to new highs, that's bullish under the Dow theory. And it's, I mean, if you just think about it from a common sense perspective, you got the industrials breaking out, you got transports breaking out. What's not to like in terms of economic, U.S. equities and economic strength? I mean, we get transports going. That's a good sign. But look at where transports are right now, right at 16,000. Been talking about this group for quite a while, saying that I thought the move down to the downside was temporary. Couldn't ignore it while it was going down, but I felt it was temporary and we'd see it come roaring back. Well, it's come roaring back. And I think we're going to get this breakout probably sooner rather than later, maybe today, with yields rising. That could put money into industrials, and that might be just what this group needs. But transport's getting ready to break out, and that would confirm under the Dow theory the breakout that we've already seen in the Dow Jones, which just set a new all-time high, closing high on Friday. All right, S&P 500 also making a breakout to new all-time highs. Can't really, can't be upset about that, right? How about the NASDAQ? NASDAQ up there at 15,498 level, closing at a new all-time high. How about the NASDAQ 100? Closing at an all-time high. We're going to look here at the mid caps. So the mid caps closed at an all-time high on October 25th. And we've since pulled back. So we got that breakout, but we got a little pullback. I'm going to come back to the mid caps in just a second, but we did get the breakout there. The only one that hasn't broken out here recently is the small cap index, the S&P 600 small cap. And you can see the sideways consolidation that's been taking place for a while. So if you've been in the small caps, into the diversified, one of the heavily diversified ETFs that track small caps, you're probably not losing money, but you're probably getting frustrated watching the S&P go up all the time and small caps not doing anything. Well, this is the reason why. We just haven't. This is not bearish, by the way. I think this is very bullish. And if we get the yields moving back up again, I think we're going to get a breakout here on small caps. I think we're going to go back, take out that June high, and I think it's coming sooner rather than later, kind of like the transports. So I would be okay with representation in the small caps at this point. But we haven't gotten that breakout. We need to see the breakout. The difference between small caps and the mid caps, which I just mentioned, is the mid caps have made the breakout, pulled back, held the 20-day, and now another breakout would be very bullish. That would be the signal I'm looking for of an uptrend. Breaking out to new highs. Sometimes you can get, when you're just looking at the moving average, as you go through the moving averages, we've done that before. We go through the 20 and the 50 and it's all lined properly, price action above the 20 and above the 50. Everything looks good and we don't get through price resistance, and then back down we go. And so then you grow bearish, and then we start coming back up again. Oh, here we go. Trending above the 20-day, which is now above the 50-day. But do we get a breakout? No. Same thing again, end of August and early September. Do we get that breakout? No. Well, This time we got the breakout. So I think this is a little bit different and much more bullish because we made the breakout, we've pulled back, and we held that first moving average, the 20-day, which I think is really critical in a trend. Look back to the mid caps a year ago in November when we made the breakout. And I mean, until we had negative divergences starting to pop up, we stayed above the 20-day. We trended above these moving averages. And even the trips below the 20 were very temporary, only to the 50-day. And then we kept going higher and higher. Now we're going through this period of sideways consolidation. That was certainly a big head fake in July. But for the most part, we're just sideways consolidating until we make another breakout. So uptrend, sideways consolidation, breakout, and I believe this is starting another uptrend until the market proves me wrong, which it could. But as long as this is trading above the 20-day at this point, I believe we're in an uptrend, and I would trade it accordingly. All right, so that's the major indices. I think the major indices are looking pretty bullish at this point. All right, now I'm going to go in do a little break it down segment. Normally I break down sectors. I'm going to break down industry groups here. So we're going to start off with the renewable energy space. So you've got renewable energy stocks, which if you haven't noticed, I mean, I was talking about this group when we got up to about 240, 250, saying if we could get through, I think I started it maybe at 240. That would have been the first sign. Well, we've taken that level out. We've taken out 250. We've taken out this 255. Now we're making a push it over at these two, but I think it's pretty clear we're trending above the moving averages. And when the renewable energy group gets going, it's kind of like semiconductors, or more recently in the last couple of years, automobiles. I mean, when the group gets going, it gets going. You don't want to be watching it. You want to at least participate a little bit. When we did our draft of our model ETF portfolio this quarter for our members, one of the ETFs that we put in there was the QCLN, which I'll come back to this chart in just a second. But the QCLN is the clean energy or clean edge green energy index fund. Look at what's going on here. So this is, just a small piece of our model ETF portfolio. But when this group is running, you want to have a small piece. A small piece can actually carry your portfolio. I'd be careful about getting too involved in the group. I mean, I wouldn't be overweighting too much because this is a group that's extremely volatile. I mean, you can see the move there. If you happen to get aggressive in here somewhere, look at what happened. Went from 90 down to under 60 in 3 or 4 weeks. 1/3 of your investment gone in 3 weeks, 4 weeks. So you have to understand the volatility. It's okay to have a piece in your portfolio. Just be careful when you get in these real volatile areas that you don't overweight too much. But let's go back to the renewable energy here. So the DW CRE, really looking nice. Let's take a look at some individual stocks here. First Solar. I think First Solar made a massive breakout here above 109. That was the January high. And I think if we go back 5 years on a weekly chart, I mean, you can see the significance. We went up, ran from $30 to about 109, 110, and went all the way back down to this 50-week moving average, held on to price support, and then started rolling back to the upside, just making a breakout. So nice breakout on First Solar. Some of the others, couple that I've been fans of over the last couple of years, Solar Edge is one. Solar Edge making a big move. It's likely going to test this 375 area, and eventually I believe we're going to see it go through. Then you've got Enphase Energy, ENPH, which just made the breakout. Huge earnings report, huge response to that earnings report, and it has continued going up, taking out these prior highs from back in February and March. Going to look at a long-term chart, I mean, you can see the significant push that this stock has had over the last 4 years. I would love to have gotten in. I'm sure everybody would have, right around that 75 cent area. That would have been a pretty nice little gain. But these stocks are probably going to do well over the next decade. But you've got to be willing to go through rough patches, because they're based so much on future growth that when any growth story comes out, or whenever growth is questioned, these stocks are going to get hit hard, because they're not being bought based on their balance sheet. They're being bought based on their future growth. And that future growth is going to come into question from time to time. But when they're in favor, they make big moves. So Enphase making a breakout, looking solid here. How about Sunrun? RUN? This one has not quite made the breakout, but it certainly looks like it's trending higher. So I would keep this area, which is right about where we closed on Friday, kind of keep monitoring that. But a breakout above 60 would be bullish. Another breakout above 65, you're taking out another set of resistance levels. I think as long as it trends, which means to me staying above the moving averages, PPO in positive territory, these are stocks you can go with, but you have to have more of an aggressive mindset. These renewable energy stocks are not for everybody. You could get into this stock 57. These, could take a big hit. You could be down 10% in a day or two and still just testing the 20-day. I mean, that's how fast. I mean, look over here. Breaking out, looks solid. Literally the next day, it went from a high of 74 down to a close at the 20-day at 63. $11 in 24 hours. So don't think that these, you just hold them and, it starts working on your emotions if you're trading them. So make sure that you're comfortable with that kind of risk. Jinko Solar, JKS, big move up back here, sideways consolidation for a while, back up, testing this area, move through 63, 64, be bullish on Jinko. Plug Power, full disclosure, I own Plug. I think Plug made the breakout last week. You can see above this 35 level. This is one that's very aggressive. This stock could be at 75 in 30 days, or it could be right back down here at 23, testing support. I'm going to be following the 20-day pretty closely. That will likely be my trigger on whether to get out. As long as it stays above the 20, keeps trending, I'm okay with it. I can tell you it's aggressive money that I have invested in here. It is not safety, put it away and not pay any attention to it for a while. That would be a big mistake, I think. But Plug, I think, looks good. Fuel Cell, FCEL. This one hasn't made the breakout. Just recently went back below the 20. So on a relative basis, for whatever reason, this one's not doing nearly as well as some of the others. And for that reason, I'd probably stay away from it. I mean, it could make a fortune. It could easily, you can see how fast it moved from $2 to $30, 3 months. So that's the kind of juice you could have by being in a stock like this. But it could easily be back down to 5 and change very quickly. And from $8, that would be painful. So just keep all of that in mind. All of these stocks are aggressive, but some are much more aggressive than others. The other thing I wanted to point out here, the other area in Break It Down, were the autos. Oops. So if we just pull up the chart on the autos, there's your breakout, taking out that January high. If we go back 2 years, or actually go back 3 years, look at the move that the autos made. Took a while to digest it, probably about 10 months, sideways consolidation, but now we're running away again to the upside. I believe these companies are running up for a reason. There are lots of folks that would look at a chart like this and say, oh my gosh, don't want to touch, they're way overbought. Well, I mean, if you'd said that on the way up, you'd have missed the whole run because it was pretty much overbought all the time. I really believe in the growth of these autos, especially Tesla. I'm a big Tesla fan. I've said on many occasions, if there was one stock you put my hand to the fire and said you have to hold for 10 years, what stock is it going to be? For me, it would be Tesla. I think Tesla, there's a lot of naysayers on Tesla. I mean, this is probably the most widely debated stock. It's the new Amazon. Remember when Amazon couldn't make any money? I was one of those on the other side saying they can't make any money. I can't invest in this thing. Just keeps going up and up and up, and they never make any money. Well, that's now I'm kind of flipped, and I'm on the other side because I learned my lesson with Amazon. Follow the technicals. When Wall Street is accumulating, they're accumulating for a reason, and probably reasons that we don't even know about, or maybe reasons that don't get talked about enough in the media. Because if they're buying, they don't necessarily want everybody else buying. That's my opinion. So I don't know. I don't trust a lot of the things I hear in the media, but I do trust what I see on the charts. And autos back on fire again. I love Tesla. And I know Tesla's had a huge run. I don't know where it's going to be in the short term, but I do think it's going higher long term. Speaking of Tesla, let's pull the chart up. We'll just take a look, go back to the 1 year now. So Tesla's made a big run. I mean, we got through that 900 area. And when you make a big breakout like that, you just get a whole new set of buyers that come in. And you can see Tesla just not really settling down. I saw earlier it was up this morning, pre-market, another $30. I mean, I don't know where it is now. It could be anywhere. But, you know, when you get on these rolls, this is when you want to be in these stocks, when they make these moves, because they usually make them swift, and then they'll go to another level and then consolidate for a while. And that's when it gets frustrating to trade. You know, you get them on a pullback, and you think, okay, here we go. And it goes back up, doesn't break out, and then it's right back down to where you bought it at. So, and it's going to go into one of those phases, but right now it's certainly in a breakout phase. Ford Motor just broke out. You know, I had an interesting conversation with friends recently, and I was talking about Tesla and how much I love Tesla. And they're like, oh no, Ford's the better play. Ford's the better value. You know, they've got the electric vehicles and you don't have to pay a fortune, you know, for Ford. And so what I simply said is, that's not what Wall Street's telling us. Look at the 15-year monthly chart on Ford. Better yet, let's go back 25 years on Ford. You may not realize that Ford back in 1999 was almost $24 a share. In 1999. Now it's $17 a share, 22 years later. And I'm always hearing, well, yeah, they pay such a great dividend. Well, if you're in it for the dividend, that's fine. But you're obviously not in it for the capital growth, because Ford's had none. I mean, yeah, they've had it off the pandemic low, but we saw this back off of the low in 2008. Financial crisis. Ford made this big rally. And then what happened over the next decade? Nothing. Now you look at Ford and then you look at Tesla. Of course, Tesla didn't go back 25 years. What's Wall Street telling you? Which one's the better company? I don't know. Pretty obvious to me, but I'm definitely jaded by the technical one. And I actually think fundamental analysis is strong on Tesla as well. I mean, we've got growth that's just unbelievable. And in a interest rate environment where, you know, your yield's 1.5, 1.6%, that growth in this environment, there's nowhere else to put your money. In this environment, PE ratios, I could go on a long tangent about PE ratios, and I don't want to do that because we're running out of time and I got some other things I want to talk about. But PE ratios, you can't compare PEs in 2021 to PEs in year 2000. And the reason you can't do it is because interest rates are at 1.5% now, and they were at 7% or 6% back then. So your alternative back then was to put your money into a treasury and earn 6%. That's a completely different animal than your alternative today of putting your money in a 10-year treasury for 1.5%. If you're really worried about inflation, can you imagine what that 1.5% treasury is going to do for you in the next 5 years, 10 years? Now, I'm not overly concerned about inflation, but if you are putting your money into a 1.5% bond, I mean, you might as well just hand me your money. I mean, I would thank you for it. You know, hand it to me. I'll take it. I mean, it's going to be, you're just going to be throwing money away. So I'm of the opinion, and I valued companies in public accounting a couple of decades ago, but the principles are still the same. And the reason why the stock market is going crazy is because interest rates are so low, and growth in a low interest rate, low inflationary period is so valuable. All right. I said I wasn't going to go off on that tangent, and then I went off on the tangent. Next up, GM. General Motors not really performing well. We saw Ford breaking out. What's going on with GM? Relative weakness, so I pass. Harley Davidson, hog. Look at the trend down. I mean, it's had positive divergences all the way down. Can't seem to get anything going. Pretty good support down around 31, 32, but sitting at 36, I don't know. Not a fan here. Race, this is Ferrari. Ferrari just broke out. So I actually like Race, and I would be more of a fan of Race than I would Ford. I like the breakout, and I think their growth prospects are certainly better than Ford, in my opinion. Xpeng. Now this is Chinese company, and it's in the auto space, but it did just break out above this prior high, and you can see the volume picking up, one of its heavier volume days of the year. So this one I think looks kind of interesting to me. We'll see whether or not it continues to hold its 20-day. That would be the critical level for me. NEO, I saw their October orders were down, and the stock was down in pre-market today. Might be back below the 20-day. So this one was trying to make a breakout short term, but it's still closer to its low than it is its high. And in an environment where autos are going up, I don't know. This one, and I was looking at the stock when it was making this breakout above 42.5. I thought, okay, here we go. But it failed. It came back down. It's just not performing as well as some of the others. And then you've got something like Blink Charging, which just making a breakout. I just want to tell you, this is a stock that is very heavily shorted. Now, there's probably a lot of folks still in the money on the short side. So I don't know if this is the start of a short squeeze, but if this keeps going to the upside, you certainly have to at least consider that possibility. Same goes with Workhorse Group. It's everybody's shorting, and this is, I think, the number one stock right now, number one shorted stock, or maybe it's number two, but it's very heavily shorted. And this downtrend right now, a lot of shorts are in the money. They're making money hand over fist. You're not going to get a short squeeze when you're going straight down on a stock, because anybody shorting it is making money. They have no panic. There's no reason to panic. Going up 1 or 2 days, it's not going to make shorts panic. We need to see breakouts above the moving averages. We get up to about 10. All of these folks that shorted in, now thinking about they better cover. That's what could trigger a short squeeze. And if you're thinking, well, I don't want to miss the run from 6 to 10. Well, I can tell you the run from 10 to 20 probably will be faster than the run from 6 to 10. So with short squeeze stocks, I don't care about missing the initial run. Look at this. If you tried to short it all the way down, it's had a heavy short interest, but if you keep trying to short it when it's trending lower, there's no short squeeze. I would stay away from heavily shorted stocks that are downtrending. Don't do anything with them until they start to turn back to the upside. All right, earnings spotlight, not really a whole lot going on this morning. I did see On Semiconductor. We'll pull that chart up, or pull the real time up in just a minute. But this is a semiconductor which gapped up. I think was just sideways consolidating. And there are some that would look at this and say, oh, we got a head and shoulder, left shoulder, neckline, head, right side of the neckline, right shoulder. Well, I don't like topping patterns at all in a secular bull market, number one. I'm not looking for topping patterns. I'm looking for continuation patterns. I think the market's going up. So I'm not going to look for topping patterns. That's point number one. Point number two, the right shoulder is above the left shoulder. The right side of the neckline is above the left side of the neckline. This thing's upsloping. That is not what I look for in a topping head and shoulder pattern. I want this to come down a little bit below this and have a slight down slope. I want this right shoulder not to be able to reach the left shoulder. I want this thing tilting like it's about ready to collapse and then have that breakdown. The problem is if it came back down and went below this 41.75 level, we still got support at 41 even, or whatever this low is over here. So if you break the neckline, you haven't even broken down below the neckline itself. I mean, the left side of the neckline. So anyway, I don't look at it like that. And the earnings came out very strong, 87 cents versus 74 cents. Stock's up 12% this morning. So On Semiconductor, I think, looks really strong. We will have earnings. There's not a whole lot out this morning, and certainly not any huge moves. This was the biggest mover that I saw. But the rest of this week, we are going to have a ton of companies reporting. So this is the biggest week of the quarter in terms of number of companies. So next up, the three you must see. Just go through these quickly. Market getting ready to open. Starbucks, not a great report. Supply chain issues. I think the revenues came in a little light. I can tell you, I go to Starbucks every day. I can't tell you how many times I see people walk in and walk back out because the lines are so long, staff shortages. I believe when I was watching in Starbucks, I was thinking they can't possibly meet their numbers the way the people are walking out. I mean, they just don't have enough help. But anyway, they broke down here. I could see this stock down to 95 or 97.5 or whatever. No, that's 95. That's a possibility on Starbucks. I think it trends lower. I think it's a great long-term investment. Short-term, it's just got some issues. IMO, this is Imperial Oil. I don't like that reversing candle. That's a bearish engulfing candle. You don't see, I looked at the PPO earlier and it was negative. So you got rising price, lower PPO, reversing candle. I think it's going to go back to that 50-day moving average. Last stock I have for you is RLGY. This one's been beaten up, but I was just looking at the support area here. You got gap support and price support in that 16 and a half area. So any selling here could set up an opportunity or an RLGY. All right, that's it for me. Market did just open. I'll give you a quick little market update. NASDAQ up 30, S&P 10, Dow up 20 or 96, all of them up about 20, 0.2% up to 1/4%. Look at small caps and mid caps, though, leading. And I'm telling you, I think the mid caps are looking good. Small caps, I think, could be on their way to breaking out as well. Everybody have a great day. I will be back tomorrow over at Stock Charts TV at 9 a.m. So if you want to catch my next show, just go over here at 9 a.m., click on Stock Charts TV, and you'll be able to pull up the show. Appreciate you tuning in. Everybody have a great day, and I'll be back tomorrow. Happy trading.